All right, folks, we're into section 1.2 of your textbook. There are 3 questions. The first one is this: what is the primary task of management? The chief executive officer, the chief financial officer, the chief operating officer on behalf of the shareholders of a publicly traded corporation. So let's think this through. For a publicly traded corporation, there will be many shareholders. Shareholders are people who have bought a piece of the company. They have bought stock in the company. They're the owners of the company. And there are often many shareholders. We saw that for the NASDAQ stock market, there's a minimum listing requirement of a float of 1 million shares. All right, if you had just 10 shares per person on average, that doesn't have to be the case, but let's just say that was the case. That's still 100,000 shareholders. It's a lot of shareholders out there. They have many different needs and views in this life, but they've all bought a portion of a particular corporation. So what they will do is elect a board of directors. Each year, they'll get in the mail a vote to elect the board of directors. Or maybe some companies do it electronically, or maybe some of the companies have certain board of directors that will be on the board for 2 years, and then others will be on for 3 years. Some will have rotating serving times on the board, so only half the board gets elected in 1 year and half the board in the next year. Anyway, the shareholders elect board of directors, and these board of directors then are tasked with ensuring that the company's vision and mission, as publicly stated, it must have been publicly stated and clarified long before the company went public. Right? The board of directors is tasked with making sure that this vision and direction and all the bylaws get enforced and that mission and vision get carried out. So they're kind of like a management on a very meta level. They're tasked with ensuring that it gets done, but they're not the ones who do the work. They don't run the day-to-day operations of a corporation. That, in turn, is done by agents called management. These are employees of the company hired by the board of directors to manage the corporation on behalf of the shareholders. At the top of management, you have the CEO or chief executive officer. Below that, you'll have the principals like the chief financial officer on the financing side and the chief operating officer on the investing side. And there'll be all sorts of managers underneath that, and then maybe tens of thousands of employees or whatever the corporation has. Management are agents working on behalf of shareholders who are the principals. The shareholders are the owners. They elect the board of directors. The board of directors might have like 17 to 20 people on it, depending on the bylaws of the corporation. These board of directors are often owners of shares, often experts, and these board of directors have the task of making sure the company is properly carrying out its mission and vision according to its bylaws. And to do that, they hire management to run the company in the day-to-day operations. And the management have a primary task on behalf of the shareholders. That's what we're trying to answer. What is that primary goal? The management has primary task on behalf of the shareholders of a publicly traded corporation. There will be many investors. There will be many shareholders in this corporation, many owners of the corporation. Consider Tesla. Tesla has 1.044 billion shares of its stock outstanding. Now, of that, Elon Musk, who you've heard of, owns 17% of the shares in existence. So he's by far the largest owner. Other Tesla insiders, board members, own 1% of the shares. There are another group of investors, about 300 or so of them, called institutional investors. These are big money investors that are investing large amounts of capital. They may own something like 5% of the company or 3% of the company or 2% of the company, and they're in there for the long haul. They're big players. These are called institutional investors. They own about 42% of Tesla. But the remaining Tesla shares, the remaining 40%, the remaining like 400 million shares that are out there are just owned by retail investors. Those are investors like you and me. We say, I think Tesla's a good company. I want to buy a few shares. How much is a share trading at right now? $888 per share on the NASDAQ. Okay, so how many shares can you and I actually afford? But 1 share, 5 shares, 10 shares, depending on how rich we are. Maybe we even get 100 shares later in life. But you get the point. If we're talking about 400 million shares at $888 per share, there's still hundreds of millions of shareholders in Tesla. So the retail investors, you and I, who own a few shares of Tesla each, we will get something in the mail each year that says, elect your board of directors, and we'll elect them. These are the current board of directors of Tesla. Notice how many there are. There are 8 members of the board. And look who is on the board, Elon Musk. Yeah, he owns 17% of the shares. If he owns 17% of the shares, you bet he's always going to get himself elected because he gets to cast 70% of all the ballots. All right, and these other folks on there, you may or may not have heard of them. They all are very famous names. James Murdoch, Larry Ellison. You probably have heard some of these names before. And no, you haven't heard them in association with Tesla. You heard them in association with other big things that have happened in this world. And they're serving on Tesla's board because they're considered to have maybe the expertise in business, the expertise in energy and automotive that Tesla needs to make sure their vision and mission is carried out. The board of directors then is tasked with hiring management. Management are the managers who run the business day to day. These are the employees of the firm that get paid salaries to make sure that the mission and vision is carried out on a day-to-day basis, and are beholden to the board of directors and ultimately to the shareholders for whom they're working. Maybe the board of directors has a meeting every month where management reports to them, and maybe the board of directors are there every once in a while checking up on the managers to see that they're meeting the vision and mission. The managers are working day to day. Now, there are many managers in the corporation, but the top guy is always the CEO, and you know who it is for this corporation. It's Elon Musk. Then there's always 2 primary sets of decisions a company's making: the investing decision and the financing decision. Okay, on the financing side, the most important manager is the CFO, or Chief Financial Officer, and that's Zach Kirkhorn. All right? And the most important manager on the investing side, the guy who decides kind of what we're going to build out, what our new investments are going to be, what's our kind of new direction for fulfilling the mission and vision through procurement assets or other businesses or building businesses. That, in this case, is the senior vice president named Andrew Baglino. All right. These guys, in turn, have many managers working for them, and then tens of thousands of employees beneath them. This then is a visual on what is the primary task of management on behalf of the shareholders. Can you figure out what it is? That's a stock chart for the past 5 years for Tesla Inc. Notice what's happening to the stock price. It looks like from 2018 to 2020, it's hovering in the, what does that look like, about $100 range. And then you see a pretty nice rise up to current stock price of $868. Yeah, there's some peaks and valleys along the way, but you can see it's a great upturn from 2020 to 2022. The primary task of management on behalf of the shareholders, what do you think it is? Is it to raise the stock price? Here's the answer. The primary task of management on behalf of the shareholders of a publicly traded corporation is always to maximize shareholder value. Really burn that idea into your mind. Other synonyms for maximizing shareholder value is called maximizing shareholder wealth, particularly to increase the current value of the company's shares, that is the stock price, and hence the wealth of its owners. Right? If you ever see on a test or a quiz or a rat, what is the primary task of management? It's to maximize shareholder value or to maximize shareholder wealth or to increase the current value of the company's shares and therefore the wealth of its stockholders. There are other answers out there that you may be tempted to think about when you think about the primary task of management on behalf of the shareholders, but they are not correct, okay? These are not the answer to the question. Let's make sure we understand what is not the primary task of management. It is not to meet the social or societal goals of the shareholders. You may think Tesla Inc. is involved in energy and clean energy, right? And that is great. That is a big motivator in their success. That's clearly part of their mission and vision. All right, but that's not why people are investing in Tesla Inc. And there's no way to meet all the social and societal goals of all the investors. Remember, there's probably at least 100 million investors out there. Everybody's got different opinions and thoughts on this world. That can't be the goal of management, to try to please 100 million people with all different views. That's not the primary task of management. It's not to meet the risk tolerance of the investors. Remember our two investors in Peachco, owners of Peachco? They were very risk tolerant. They want surely management to do the riskiest venture that has the biggest possible return. But there are other people out there like me who have very low risk tolerance, and we don't like really risky things. It is not the job of management to try to cater to the risk tolerance of the investors in the company. Why? Because the stockholders are going to change hands all the time. Retail investors are constantly buying and selling stock through the stock exchange. Owners change hands. Management cannot spend its time trying to meet the risk tolerance of the investors. Nor is it to meet the consumption timeline of investors. Like, when do I want to invest my money? And when do I kind of want to sell my shares and use the money to, finance my education or go into retirement? These are not concerns of management. And it's an important one. It is not the primary task of management to maximize the profits or income of the business. It is not to maximize the profits or income. You're like, well, of course that's what they want to do. Isn't that how they drive up the stock price and increase shareholder wealth? Not necessarily, right? Let's say I'm a company that has to invest a lot in research and development, like Tesla, in order to put forward an excellent product that people are going to want to buy over and over again. What if I stop investing in research and development for 5 years? Well, you know what? For 5 years, my profit or income is going to soar. It's going to go up a lot because I didn't have to spend billions of dollars each year on research and development. What's going to happen in years 6 through year 30? The company is going to have a good chance of going bankrupt because it didn't invest what it needed to invest to be on the cutting edge of new technology and lead the way in this business and make all the sales and have satisfied customers. So you can certainly maximize profit for a period of time or income for a period of time and not maximize shareholder value, not maximize shareholder wealth, right? So we can never consider maximizing profits to be a good answer here. So the primary goal of management is very straightforward and clear: to maximize shareholder value, to maximize shareholder wealth, to increase the current value of the company's shares and the wealth of its stockholders. Well, let's say you were a shareholder in our corporation that we've been talking about here. Tesla Inc. Doesn't really matter. Now, what would you do with your increased wealth after management worked hard to increase the shareholder the price of the stock, and therefore your wealth? What would you do with the wealth? Think about it for a minute. Whatever you would do can be according to your preferences, your consumption timeline, your societal goals, whatever you want to do with your money. That's on you, not on management. That's on you. When you sell your stock and make your money, you can do with it as you please for whatever goals you have in life. All right, we've been saying then that a smart and effective manager makes decisions that increase the current value of the company's shares and wealth of its stockholders. But this is the second question then. How does a manager make smart and effective decisions? What decisions actually increase the value of a company's shares? All right, we're going to look at the answer to this question. We're not going to go very deep until next chapter. The answer is management will only make investing decisions, invest in new projects, or invest in new businesses that are NPV positive, that is net present value positive. Or another way to look at it, management will only invest in projects or invest in businesses or invest in new ventures that will have an internal rate of return on that project or venture that exceeds the opportunity cost of capital. I know right now you're thinking, what? What are all these terms? Let me see if I can talk about them at least at a shallow level for you now. The net present value rule says if a project produces a positive net present value, management should do the project, otherwise it should not. I want you to think about it this way. A company, say, has to invest $100 today to get a project going. Maybe you're going to sell cookies and drinks and donuts on the corner. You're a kid. This is your company. Maybe it's not official, but that's it take $100 in investment to get this thing started. Well, hopefully right after that, you're going to hustle, get your friends to hustle. You're going to sell your drinks, you're going to sell those cookies, you're going to sell those donuts, and you're going to start generating a cash flow from the sales. And those cash flows could go on as long as you keep managing the business. They can grow if you get a couple of your friends involved, or it becomes a real popular thing. You get delicious donuts and cookies. Those cash flows that are generated in the future have to outweigh the initial cost that you put in the business. But those cash flows have to exceed the cost you put into the business when you consider the time value of money. And let me just tell you now, money is worth more today than it is in the future. Money is worth more today than it is in the future. So that initial investment is going to be more weighty than all those cash flows in the future years. And there's a mathematical way to account for the difference in the time value of money of distant future cash flows and present cash flows. If you're having trouble with this idea, think about it this way. Would you rather get $1,000 from your Aunt Betty today or $1,000 from your Aunt Betty next year? All right, if your answer is, it really doesn't matter to me as long as I get $1,000, I get it. You just are glad your Aunt Betty is giving you $1,000, but you should definitely want the money today. And here's why. If you get the money today, $1,000 today, you can go and invest it. Even if you invest it in a bond that's paying like 2% per year, a pretty safe bond paying 2% per year, you know, how much money will you have at the end of a year? $1,020, right? Which is better than $1,000. And if you invested it in something that gets a 10% rate of return, at the end of the year, you'll have $1,100 instead of $1,000. So you want $1,000 today, not a year from now. Money's worth less in a year from now because you've missed the opportunity to invest it and make more money on it. Do you see that? All right. So if a project is net present value positive, has a net present value greater than zero, then the managers want to invest in it. Another way to look at this is the internal rate of return. If a project produces an internal rate of return greater than a business's opportunity cost of capital, management should do that project. Otherwise, it should not. Let me break this down for you. Every investor in Tesla Inc. has in their mind a certain amount of return they're going to get for investing in the company. They think that they're going to buy the company at $10 a share and sell it the next year at, buy it at $100 a share and then sell it at $110 a share. And they're going to make a 10% rate of return. And that's just not arbitrary. It's not just what anybody thinks they're going to make on Tesla. Tesla is about a little bit more risky than the regular stock on the stock market, or as it has been. But now it's become a market leader, so it's become about as risky as other stocks in the stock market. The stock market will produce, on average, a compound annual rate of return, just think of an annual rate of return of about 10% per annum. It's fantastic. That's why people should invest in the stock market. It makes people wealthy. All right. Since the company has a risk profile similar to that of the overall market, all the investors out there are thinking to themselves, I should be getting a 10% rate of return whenever I buy Tesla's stock. After I sell it, I should be making about 10% per annum on this. That's the investor's opportunity cost of capital. If Tesla doesn't make a 10% rate of return on their money for them, what's going to happen? The investors, the stockholders, are going to be like, this is not worth owning this stock. I don't want it. I'm going to go invest in some other company or the entire market, which I know is going to get me a 10% rate of return. Maybe they'll just buy an index fund share, a mutual fund share that mimics the market, and they'll make 10% per annum, because that's what the stock market does. You see, so there's no way Tesla is going to invest in new projects, take on new ventures, buy smaller companies with technology that'll improve their profile. There's no way they're going to make those investment decisions if the expected rate of return on those investments is anything less than 10%. They're going to want rates of return something like 12%, 15%, 18%, because that's going to exceed their investors' opportunity cost of capital. Right? Let's say Tesla has 17 projects on the horizon for the year, and only 7 of them have a internal rate of return, an expected internal rate of return of 13% or more. Then it's probably going to invest in those 7 projects, because the investors in Tesla have an opportunity cost of capital of 10%. Since the internal rate of return rule tells me that I will always do a project that has an internal rate of return greater than the opportunity cost of capital, I do those projects. But those few projects out there that can make some money, but only getting a 6% or a 7% internal rate of return, don't do them, because that's going to reduce the internal rate of return profile of the company. And therefore, a lot of investors are going to flee from the corporation because they can make the same money by just investing in the overall stock market, make better money, 10%. That's their opportunity cost of capital. All right, we're going to look at this math in detail in chapter 2, so don't worry about it if you don't really understand it deeply, but do understand it enough to be able to answer some basic questions. Last question that has to be answered. What if management does not take its responsibility to the shareholders seriously? Right? Management effectively works for the shareholders. The shareholders are the principals or the owners, and management is the agents working on behalf of the shareholders. They have a responsibility to the shareholders. They have a duty to the shareholders to maximize their wealth by maximizing shareholder value. But sometimes, most of the times, I will say management, they're just like employees of any other business. They want to do a good job on behalf of their shareholders. They want to be competent. So the corporate governance and the oversight of the board of directors will be there in place to make sure that management is doing what they shouldn't do. Now, should do what they ought to do on behalf of the shareholders. If management's not doing that, board of directors will fire them and hire new managers. And that's pretty much how it goes in most businesses. Now, sometimes management can be oriented in such a way that they're really not interested in being a good and responsible agent for the principal. Really doing a good job on behalf of the shareholders. I don't know, maybe they're fraudsters. Maybe they just have reached a place in their life where they're concerned more about their own personal interests than they are in the shareholders' primary goal. Well, this is what we call agency costs. There's a conflict that can happen, often does not happen, but can happen between management and shareholders, where management will put their own interest ahead of shareholders' interest. That conflict generates costs called agency costs. I mean, if you have a fraudulent management, some sort of evil management that's not doing what they ought to do and gets exposed, then the agency cost of the shareholders is maximal. It could even be a complete bankruptcy of the company and the shareholders' wealth going to zero, right? But it could be some smaller things like that. Maybe management maybe the CEO thinks he's all that, so he starts having big lavish parties on the company's dime. Your book cites some CEO has spent, I think it was $2 million for a party for his wife on the company's dime. Well, that's serious money to be taken out of the business that really should not be taken out of the business. And someone who's acting that way may not have the shareholders' best interest in mind. And these are costs that will negatively impact their shareholders. Those are called agency costs. The other aspect is making sure that the business has enough structures to prevent management from abusing its position or not taking its responsibilities seriously. That is oversight by the board, oversight by auditors, oversight by whatever internal controls need to be put in place. That involves tying management's bonuses and income and credibility to their performance on behalf of the shareholders, which may be additional costs to the shareholders. Those costs, to make sure that management is aligned to the shareholders, are agency costs. So both the preventative costs of putting a good structure of oversight into place to make sure management is aligned with shareholders are agency costs, and whenever management abuses their role and doesn't take the responsibility seriously and it costs the shareholders, those are agency costs as well. All right, but let me just tell you, it's not like all the movies and the hype and the negative things you hear on the news. Most managers of most corporations are people who are driven and hardworking, trying to do an excellent job on behalf of their shareholders, trying to be successful and competent in what they do, and they take their responsibilities seriously. Some are more gifted than others. Sometimes the less gifted ones don't make it and they get fired because they just can't pull it off. And there's some out there who are fraudsters or abusers, and hopefully they get fired or taken out of the system. That's what corporate governance and systems of controls are in there for, to try to weed that out. You can't get 100% of it, but corporations will do their best to keep that stuff reined in, make sure management's aligned with the shareholders. Of course, you've heard abuse stories like Bernie Madoff, who scammed hundreds of millions, billions of dollars out of people and then left them high and dry. That happens, but those are the exception rather than the rule. Thanks.